This topic is about orders and execution instructions from Learning Module, Market Organization and Structure. Best bid is the highest price someone wants to pay. Best offer is the lowest price someone wants to sell at. The market quote is always the best bid and best offer. This is where trades can happen right now. Sizes do not matter for the quote, only prices. Takes the market means your order trades immediately. Would be below $41.50. Makes the market means your order matches the current best offer. Would be at $41.60. Makes a new market means your order becomes the new best offer. Taking the market means your order trades immediately. Buy at offer or sell at bid. Making the market means your order matches the current best bid or offer. Making a new market means your order improves the current best bid or offer. Since your buy price equals the offer price, €20 and 51 cents, you will trade immediately with someone selling at that price. Stop $140, limit $150 is a stop limit buy order. It triggers when price reaches $140, then becomes a limit buy order that only executes at $150 or lower. Stop limit orders do not guarantee exit, unlike stop market orders, which execute but at uncertain prices. If price gaps above $150, for example, jumps from $139 to $160, the order never executes. Short position remains open. The loss is unlimited. You bought at $55 and it is now $70. You want to lock in most of that $15 profit in case of a crash. To protect a long position, you need a stop sell order. By placing the stop at $65, the order stays suspended as long as the price is high. If the drug trial fails and the price drops to $65, the order becomes a valid market order to sell your shares immediately. Using a good till cancelled instruction ensures the protection stays in place for days or weeks until the drug trial results are actually released. Best bid is $85.20. Bid-ask spread is 0.5%. 0.5% of $85.20 equals $0.426. So offer equals $85.20 plus $0.426, approximately $85.63. Your limit order is to buy at $85.70, means you will pay up to $85.70, but you want the best price available. The best offer available is $85.63. The order will fill at the best available price, which is $85.63. A stop buy order is used to limit losses on a short position. It is triggered when the price rises to the stop price, at which point an order to buy is activated, limiting further losses. A stop sell order is used to protect profits on the long position or limit losses if the price falls. A limit buy order is used to buy at a specific price or lower, but it doesn't protect against unlimited losses if the price keeps rising. Stop $65 means if price falls to $65, the order becomes active. Limit $60 means you will only sell at $60 or higher. It is a stop limit order, not a regular stop loss market order. Your cost was $75. The worst you'll accept is $60. The limit price caps your loss. $75 minus $60 equals $15. Maximum loss $15 per share. When you place a buy limit order at or above the current best offer price, it becomes marketable and executes immediately at the best offer price. Here, buy limit at exactly 99.00 matches the current best offer. Immediate fill at 99.00. A pure market order also buys immediately at the best offer, 99.00. Therefore, both types get executed immediately at 99.00. Validity instructions indicate when an order may be filled. Day order means cancels at end of day. Good till cancelled mean the order stays until filled or cancelled. Immediate or cancel means fill now or cancel rest. Time-related rules, day order, good till cancelled, immediate or cancel are always validity instructions. Execution is about price or type. Clearing is about settlement. Topic: Primary security markets. Even though the company is already listed, issuing new shares is primary market because new capital flows to the issuer. This is a seasoned offering, not a secondary offering. Both IPOs and seasoned offerings are primary market transactions. Secondary market trading does not give money to the company. Syndicate of investment banks is typical for primary market underwritten offerings. Secondary markets support primary markets by providing liquidity. Investors buy new shares knowing they can sell later. New issuance equals primary market, regardless of prior listing. Firm commitment means bank guarantees proceeds. Bank bears risk of undersubscription or having to sell at loss. Underwritten offerings is where lead underwriter purchases entire issue and assumes inventory risk. This is a seasoned offering, but still primary market. New funds to issuer. Syndicate helps lead underwriter manage risk by building book of buyers. Secondary market risk, where price fall after issuance, is on buyers, not underwriter. Underwriter takes the primary risk in firm commitment to ensure issuer gets capital. Private placement means new securities sold directly to small group of large institutions, for example pension funds, insurance companies. Still primary market transaction because new issuance and proceeds go to issuer. Faster and cheaper than public offering, no full registration, less disclosure. Private placements as alternative to public offerings for raising capital quickly, especially for already public companies. Rights offering involves existing shareholders proportionally. Rights offering is when company gives existing shareholders first chance to buy new shares at discount. Pro rata. Transferable rights mean shareholders who do not want to buy can sell the rights to others. This is primary market transaction. New issuance, funds to issuer. Rights offering is a method for public companies to raise equity capital while giving existing owners priority. Dividend reinvestment plan, or DRP, is automatic reinvestment of dividends, not issuance of new rights certificates. Private placement is non-public, direct to qualified investors. The 1:5 ratio and transferable certificates are classic signs of a rights offering. Rights offering is a primary market transaction, even though shares go to existing shareholders. New shares are created. Company receives capital. That is primary market. Primary market includes both IPOs and seasoned offerings, new shares by already public companies. Secondary market means only trading of existing shares, no capital to issuer. Rights are short-term warrants allowing shareholders to maintain ownership proportion. Anti-dilution. Primary market means company sells new bonds directly to investors. Company gets the money to use. Secondary market means investors buy or sell existing bonds from each other. Company gets nothing. Primary market is where new securities are issued and sold for the first time. Direct purchase from issuer is primary market, whether public offering or private placement. Brokered market refers to how trades are arranged. The broker helps, not whether it is primary or secondary. Topic: Secondary security market and contract market structures. Order-driven markets and execution mechanisms confirms that order-driven markets match orders using a strict precedence hierarchy. Price priority first. The best price executes first. Highest bid for an incoming sell order. If prices are tight, display precedence applies next. Displayed orders before hidden orders. If price and display status are both the same, time precedence is the final tiebreaker. Earlier arrival first. In this case, prices are not identical. 10.10 is greater than 10.05, so only price priority determines the match. Arrival time of order B and display status of order A are irrelevant. Order-driven markets match in price priority. Limit orders execute only at their limit price, or better. Incoming sell limit at 40.06 or higher fills against bids 40.06 and above. Only bid C 40.20 and bid A 40.10. Total filled 1,000 shares at weighted average is 40.14. Quote-driven markets involve dealers who post two-sided quotes, bid and ask, and are ready to buy or sell at those prices. Customers contact dealers and trade directly with them. This is the dominant structure for foreign exchange or currency markets and many over-the-counter markets. The scenario describes exactly this. The treasurer calls banks, the dealers, receives quotes, and executes with the dealer offering the best quote. Brokered markets use intermediaries who arrange matches between buyers and sellers without quoting prices themselves. Order-driven markets rely on an order book with public limit orders matched automatically, not on calling dealers for quotes. Brokered markets are used when buyers and sellers do not trade directly with each other or through dealers, but instead use brokers to arrange trades. Brokers are especially important for infrequently traded securities, such as many corporate bonds, and for large trades where participants prefer privacy and minimal market impact. Brokered markets are common for assets that do not trade frequently or in large sizes that would disrupt public markets. Quote-driven markets are described as dealer intermediated with posted quotes, typical for some bonds, but less so for very thinly traded ones. Order-driven markets rely on continuous matching of public limit orders, more typical for highly liquid equities. Significant position in infrequently traded corporate bond aligns directly with the description of brokered markets. Topic: Well-functioning financial systems. A well-functioning financial system has low transaction costs and liquid markets. Liquidity means traders can buy and sell easily and quickly without big price changes. When trading is easy and cheap, information-motivated traders are more willing to act on new information. Their trading brings prices closer to true value, so prices become more informative. Well-functioning financial system has low transaction costs and liquid markets. Low transaction costs include narrow bid-ask spreads and low brokerage commissions. Liquid markets allow investors to trade significant sizes without substantially moving prices. These features define operational efficiency. Well-functioning characteristics. Informational efficiency concerns how well prices incorporate information, not mentioned here. Allocational efficiency concerns directing capital to best uses, not described here. A well-functioning financial system has low transaction costs and liquid markets. Liquidity means traders can buy or sell significant amounts quickly without substantially affecting prices. Low transaction costs encourage trading, including by information-motivated traders, which helps make prices more informative. Good disclosure and transparency support price discovery and capital allocation, the opposite of opaque markets or minimal disclosure. Topic: Market regulation. Objectives of market regulation include protecting investors from fraud, misrepresentation, and theft, ensuring fair and orderly markets, promoting efficient price discovery and capital allocation through transparency and standards, such as financial reporting rules. It emphasizes that well-functioning systems allow risk-taking while protecting against abuse, fraud, and unfair practices, not eliminating the possibility of losses. Regulators focus on protecting investors, preventing fraud, ensuring fair and transparent markets, and maintaining system stability. They do not promise or guarantee profits or positive returns for investors. Investing always involves risk of loss. Regulation sets rules and standards, like reporting rules, but does not eliminate normal investment risk or guarantee returns.